You spend decades aggressively saving every extra dollar, sacrificing vacations, and meticulously building your credit score just to finally purchase your ultimate dream home. You start picturing a peaceful, financially secure future where your equity grows and your family is protected. Until one Tuesday afternoon, you open your mailbox and find a cold, sterile non-renewal letter from your homeowner insurance company that completely shatters that vision. Suddenly, it is not just the physical storms you are worried about. It is an entirely broken financial system that has quietly decided your specific neighborhood is mathematically too risky to cover. Across America, this hidden insurance crisis is rapidly accelerating into a full-blown economic catastrophe. Massive, historically reliable companies like State Farm, Farmers, and Allstate are aggressively pulling back their capital, leaving millions of hardworking homeowners scrambling in a desperate panic as their premiums violently spike and their coverage entirely disappears overnight. The curiosity you should have right now isn't just about coastal hurricanes or remote wildfires, but how the insurance industry is quietly redlining massive portions of the American middle class out of homeownership altogether. What happens to the value of your largest asset when you literally cannot secure a policy to protect it? Subscribe to Tax Hack Pro. We follow the money, the actuarial data, and the hidden financial traps that the mainstream real estate industry desperately wants to ignore. Hit that subscribe button right now so you can protect your equity and understand the forensic data before the next economic avalanche hits your zip code. This crisis is not just isolated to the wealthy coastal cities anymore. Deep inland suburbs, places previously considered the ultimate safe havens of American real estate, are feeling the massive financial strain too. What once seemed like a rock-solid, generational investment could quickly become a devastating, uninsurable financial burden that traps you in negative equity. Let's step directly into the absolute heart of this growing financial storm. Number 10, Minneapolis, Minnesota. We kick off our financial audit in the heart of the Midwest. When you think of Minneapolis, heavy snow and deep ice probably come to mind. But the real billion-dollar headache for insurance actuaries isn't the winter at all. It is the highly violent convective storms that arrive in the warmer months, unleashing jagged hail the exact size of baseballs and intense, localized winds highly capable of ripping roofs entirely off of suburban homes in a matter of seconds. For decades, the Twin Cities area was considered a reliable, low-risk, cash cow market for major insurance companies, but the financial models have completely broken. Homeowners have seen their baseline insurance premiums aggressively climb by more than 50% in just the past year alone. Deductibles for wind and hail damage have absolutely soared, often hitting a mandatory 2 to 5% of a home's total insured value. A recent deep dive study found that insurers' loss ratios in Minnesota recently topped a devastating 100%. The insurance companies were literally paying out more money in damage claims than they collected in premium revenue. Number 9, Denver, Colorado. Heading west from the plains, we arrive in Denver, a massive, booming city framed by breathtaking mountain views, but actively hiding a highly sobering financial reality. The danger isn't just contained in the deep, remote forests anymore. It is aggressively creeping directly into the densely populated suburban neighborhoods. The devastating Marshall Fire, which completely destroyed over 1,000 suburban homes in mere hours, fundamentally changed everything. A staggering 76% of active carriers have aggressively scaled back their coverage limits in wildfire-prone areas surrounding the Denver metro. Average homeowner insurance premiums in Colorado have violently surged nearly 60% over just the past 3 years. Labor shortages and aggressively rising material costs have pushed actual reconstruction expenses roughly 20% above the national average. Living here now means actively accepting that your most valuable, highly leveraged financial asset could be sitting in a literal tinderbox. Number 8, Oklahoma City, Oklahoma. We head south directly into the heart of Tornado Alley. While the locals are incredibly tough, the brutal financial reality of owning property here is becoming mathematically impossible to ignore. Insurance companies are growing incredibly weary of paying to replace entire residential roofs every 3 to 5 years. Oklahoma consistently ranks among the absolute highest states for standard homeowner insurance premiums in the entire country, often running double the national average. Baseline premiums have aggressively jumped 42% since 2022 alone. The financial situation is so deeply unstable that several regional insurance carriers have actually gone completely insolvent, forcing the state guarantee fund to desperately step in. That specific change forces homeowners to cover a massive, substantial portion of minor damage entirely out of pocket, essentially forcing the middle class to self-insure for highly common weather events. Number 7. Houston, Texas. Most people know Houston globally for its booming energy sector, but insurance actuaries see it as ground zero for entirely unpredictable and financially devastating flood losses. The severe danger isn't just massive hurricanes rolling in from the Gulf of Mexico. It is the sudden, unpredictable torrential rain bombs that can linger stubbornly over dense neighborhoods for hours, completely submerging inland areas that absolutely never flooded before. Rapid, unchecked urban sprawl has aggressively replaced natural, absorbent wetlands with concrete. The federal government's highly controversial Risk Rating 2 system is aggressively sending mandatory flood premiums up for thousands of Houston homeowners by a legally mandated roughly 18% every single year until they finally reach the true, full actuarial risk rate. That is a compounding, inescapable annual increase that can quickly make holding on to a leveraged property financially impossible for the middle class. Number 6. Los Angeles, California. A massive global city that has long symbolized the ultimate American dream is incredibly quickly becoming an absolute insurance nightmare. LA is currently facing a highly unprecedented, massive withdrawal of corporate insurance capital. State Farm and Allstate, two of the nation's absolute largest insurers, shocked the market by announcing they would completely stop writing new homeowner policies in the state entirely. According to state regulators, 7 of the top 12 massive insurance groups have fully paused or severely restricted taking on any new business. Enrollment in the state's FAIR Plan, the highly restrictive insurance pool of absolute last resort, has more than doubled. Standard home premiums in fire-prone areas now easily run between $7,000 and $10,000 annually. To make sure you understand how these massive insurance premiums interact with your annual property tax assessments, make sure you subscribe to Tax Hack Pro. We audit the exact tax loopholes that allow you to offset these massive carrying costs against your income. Number 5. Charleston, South Carolina. Heading back across the country to the Atlantic coast, we arrive in Charleston. But hiding beneath its massive historic beauty, the city is literally and slowly sinking into the ocean. Charleston has unfortunately become the national poster child for sunny day flooding. You absolutely do not need a massive Category 3 hurricane to severely damage your highly expensive home here. Sometimes, a simple, higher-than-average seasonal tide is more than enough to breach the seawalls. Coastal property premiums have jumped nearly 50% on average since just 2020. Many private, highly capitalized insurers are flat-out refusing to renew any policies on homes built before the year 2005. Federal data reveals that Charleston recently experienced a highly destructive, record-breaking 89 days of active tidal flooding in a single calendar year. Owning a piece of this specific history is rapidly becoming a high-end luxury that fewer and fewer people can possibly afford. Number 4. Baton Rouge, Louisiana. We stay deep in the Gulf region, but head slightly inland to Louisiana's state capital. At a quick first glance, being geographically away from the immediate coast might feel like financial safety, but this highly stressed city proves that the national insurance crisis stretches far beyond the shoreline. The core problem is a massive, complex financial system in near-total collapse. After a highly destructive series of recent hurricanes, 12 property and casualty companies became completely insolvent. That massive wave of corporate financial failures forced over 100,000 local families directly onto the state-run insurer of last resort. By strict state law, that entity must purposely price its policies at least 10% higher than the absolute highest private market rate available. A highly alarming regional survey found that 17% of all homeowners in the state are now going completely uninsured because they simply, mathematically, could not afford the massive cost. Number 3. Riverside, California. Heading back out west, we land in Riverside. Hundreds of thousands of working-class families moved here over the decades to escape sky-high coastal real estate prices, only to eventually find themselves living directly in a massive, highly dangerous wildfire trap. The severe danger isn't just the actual flames. It is the relentless, oppressive heat that completely dries out the landscape, actively turning the traditional fire season into a highly dangerous, year-round risk. Policy non-renewals in specific Riverside zip codes have skyrocketed over 300% in just the past 5 years. What used to be a highly manageable $1,200 standard policy is now replaced with a highly restrictive FAIR Plan policy exceeding $4,500 annually. Families actively moved here to save thousands on mortgages, only to hand those exact savings straight over to insurance companies. Number 2. Miami, Florida. Now we head directly to the Sunshine State, landing in Miami, the highly flashy, energetic heart of what may be the absolute most dramatic, complex insurance collapse in America. What makes this specific crisis different is that it is not driven by nature alone. Relentless legal battles and highly systemic contractor fraud have poured absolute gasoline on the financial fire. Institutional data reports that Florida accounts for just 9% of all homeowner insurance claims nationwide. Yet, incredibly, it generates a staggering 79% of all related insurance lawsuits in the country. The average Miami homeowner now pays more than $6,000 per year just for basic insurance, roughly 4 times the national average. Over the past 3 years, more than 15 Florida insurers have either completely stopped writing new policies or gone entirely insolvent. Miami is incredibly quickly turning into a highly exclusive playground solely for the ultra-wealthy who can afford to entirely self-insure. Number 1. New Orleans, Louisiana. We have reached the absolute final stop on our financial audit, the city that currently ranks as the single most financially uninsurable market in America. This is a massive city heavily built below sea level, sitting directly in a highly vulnerable bowl, completely surrounded by water. Under the new federal risk rating systems, nearly 95% of all policyholders in the immediate New Orleans area are seeing their mandatory flood premiums aggressively increase by thousands of dollars annually. On the critical wind insurance side, the private corporate market has largely, completely disappeared. The total insurance expenses in New Orleans can incredibly easily consume more than 10% of the entire median household income. New Orleans is the ultimate, massive warning sign for the entire global insurance industry. And here is the harsh, undeniable financial reality. If you cannot mathematically insure a home, you absolutely cannot secure a mortgage from a bank. Without the steady flow of mortgages, the entire housing market stalls and equity evaporates entirely. We have traveled from the hail-scarred Midwest to the wildfire-stricken West, and finally to the highly flood-prone South. The map of uninsurable America is actively expanding, and your city could easily be next. This isn't just about extreme weather patterns. It is about the complete, fundamental financial repricing of risk in the 21st century. Subscribe to Tax Hack Pro to ensure you are fully prepared for this massive economic shift. Drop a comment below and tell us if your homeowner insurance has spiked this year, and we will see you in the next financial audit.